Hello and welcome to Livewire's Fund in Focus. Today I'm joined by Esteban Burbano from New York. Esteban is the Managing Director and Fixed Income Strategist for the PIMCO Income Fund. Esteban, it's great to see you.
Thank you so much, Chris, for having me here. It's a pleasure.
Could you provide us an introduction to the PIMCO Income Fund? What type of assets does the fund invest in? What are its primary objectives? And which investors are best suited to invest in this strategy?
Our income strategy is a fixed income portfolio, essentially a portfolio made up of bonds with a global, multi-sector, flexible approach. It invests in 100% bonds across the entire fixed income markets, different countries and different sectors. The focus here is on a portfolio that generates consistent income, but also has an eye towards capital preservation. We do this by focusing a portfolio that generates a consistent yield profile, essentially consistent cash flows that are serving to pay that income stream. And we hope that income stream will be the main driver of attractive returns over time.
You've mentioned that the fund's main goals are capital preservation and maximising income. Could you explain how the portfolio's management team achieves this dual objective?
Yeah, the main strategy is to build a portfolio that invest across all regions of the world, across all sectors of the fixed income market. Also very important is a flexible approach. We use this term benchmark-agnostic, which represents that the portfolio really isn't looking towards any particular bond index, but rather is centered in building a strategy that delivers consistent income. It's very flexible, it's very tactical, which means that we are adjusting our exposures to the different markets on a daily basis.
Esteban, given that rapid change is a constant in global markets, how important is liquidity for the strategy? How frequently is the portfolio management team adjusting its views and positioning to reflect changes in market dynamics?
Liquidity is paramount on any investment strategy, in particular a bond strategy. This strategy is offered on commingled vehicles that are accessed on a daily basis. And so for us, it's very important to look at liquidity across the entire portfolio and in each individual security that we are invested in. Now, to do this, we look at the portfolio on a daily basis. We adjust exposures, whether that is to the big main risk factors such as interest rate risk, credit risk, and currencies. But also we are tactically changing the underlying securities to reflect and to position the portfolio to achieve its goals of consistent income and capital preservation.
Esteban, you've talked through some of the positioning in securitized assets. Could you just explain why you're so favorable on this sector and maybe highlight some of the key differences between corporate and securitized credit?
Right, so this is a strategy that can invest across the entire fixed income market, as I mentioned. Now, typically that means that we will have an allocation towards both government securities, but also credit securities. And within credit securities, you have, by and large, a couple of options. One would be securitized positions, basically a bond guaranteed by a pool of assets. Think, for example, mortgages or student loans or auto loans, consumer loans in general. On the other hand, you have the corporate credit market. These will be bonds guaranteed by a corporate issuer. Historically, we've had a bias towards or a preference for the securitized assets because these are bonds that have a couple of benefits. Number one is your loan, if you will, your investment is backed by a pool of assets. So if anything went to go wrong, you have the underlying assets to try to recover your original investment. Also, typically you have hundreds of underlying assets guaranteeing or backing your investment. And so in other words, you're less susceptible to idiosyncratic risk from any one particular factor because you are backed by hundreds of multiple assets. And third, typically these are also bonds that have a capital structure. So you can invest in the senior portion of the capital structure or in the junior component. We are typically focused on the senior component of the capital structure. What this means in practice is that, let's say you end up investing in a pool of mortgages, right? you're not necessarily exposed to the first defaults, because that would be those losses will be absorbed by the junior investors, the junior tranches, if you will, of the underlying bond. And since we hold the senior loan, we'll be less exposed to that. That's very different from the corporate world, where you tend to have more exposure to idiosyncratic risk, because your investment is backed by a single issuer, a particular company, right? So you're not only exposed to the underlying economics of that company, but also what's going on, let's say, for example, with the board of directors or with any other dynamics of that company. That's not to say that we don't invest in corporates. We certainly do. And again, the focus of the strategy is not just on one sector of the bond market. The focus is on a diversified portfolio of hundreds, if not thousands, of securities across governments, across corporates, across securitized credit, again, across different regions around the world.
Can you give us a brief summary of the current portfolio positioning in view of the shifting dynamics in the interest rate markets and credit markets?
So one of the key advantages of this strategy is its ability to tactically adjust its exposure to different risks. So for example, exposure to different interest rate markets around the world. As a quick example of that, we've just come from a world where interest rates were relatively low just a few years ago. Think about the post-COVID years, right? So in that environment, we just simply didn't find interest rate very attractive. And that's why the portfolio had very limited exposure to interest rate markets. In other words, it had very low duration exposure. Now, fast forward to the current environment, and what you'll find is that yields are much more elevated. Depending on which country you're talking about, you'll find yields in that mid-single digit range. And so for that reason, the portfolio has increased exposure to interest rates, right? To the point where we are perhaps at the highest level that we've been in many, many years. Now, this is a reflection, again, of the view that interest rates remain elevated. And that doesn't mean that they cannot go much higher, but rather than from a long-term perspective, we find the current levels attractive. That's point number one. Point number two, we live in a world where the different major economies are growing at different speeds, or in other words, they're slowing down at different speeds. And they have different dynamics in terms of not just growth, but also inflation and debt. And what that means is that there's going to be multiple speeds at which interest rates levels normalize around the world. In other words, there's going to be opportunities for active managers like PIMCO to invest in different markets and take advantage of that relative value. And that's exactly what we've done. The majority of our interest rate exposure is in the US still, but we've taken advantage of opportunities in other major markets like Australia, like the UK, like Canada, and Europe to diversify our interest rate exposure and provide better relative value to our investors.
With persistent volatility and ever-increasing fragmentation in global markets, how should investors be thinking about using the income fund, and what can they expect from a risk-return perspective?
I think this is a portfolio that can be the keystone, the centerpiece of a client's fixed income allocation. Now, of course, every investor is different risk profiles, different preferences, different biases. And so, each investor is going to have an overall asset allocation that will look different. But within that key component, which is the bond component of your asset allocation, the income strategy can serve multiple purposes. Number one, it gives you access to the entire market, right? Because it's not invested in just one sector, it's invested across the globe, across all sectors. Number two, it gives you the flexibility, or gives you have delegated to PIMCO that flexibility to manage overall interest rate risk and overall credit risk, and therefore, navigate the current uncertainty that we're living in the world, whether that is from macroeconomic factors or for geopolitical risks. And then number three, it helps you generate income, right? So to the extent that you need a portfolio that gives you a particular dividend, this is a strategy that does just that. But even if you're not looking for a specific income, again, the fact that the strategy generates that consistent cash flow, that consistent dividend, means that it's building attractive returns over time. And this is one of the reasons why it's been so prevalent in many of our clients' portfolios.
Esteban, what might investors expect from a return perspective if investing in the fund?
With respect to where we are today and what do we expect for the strategy going forward, I think here it's important to remind everyone that a yield in the portfolio is a very important metric. It tends to have a very high correlation to forward returns. Now, of course, multiple things can happen, but when you start with a portfolio that has a very attractive yield, so for example, in our income strategy, a yield of around 6% in dollars, you have a significant cushion to manage to the volatility going forward. And so that's why when you think about what to expect for this portfolio going forward, say over the next 3 to 5 years, this becomes our starting point. The yield of the portfolio is our best guess as to what to expect. And then on top of that, we hope to add more return, more alpha, if you will, given our flexibility and our active management.
Esteban, thanks for taking us through the PIMCO Income Fund.
Thank you, Chris.
If you enjoyed that Fund in Focus as much as I did, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.